All the bright and talented people that I know are leaving. Anyone who can is. All the rich people are leaving. This country has lost more millionaires than any other country except China. Now, if you compare the populations, that tells you
3%.
Right. So we're losing the people who have created the jobs, who are creating the jobs, and who are going to create the jobs. And
11,000 millionaires left the UK last year, which makes the UK number 2 in the world with the most millionaires leaving the country, just behind China, who had 20,000 millionaires exit the country in 20.
The UK is dying and nobody's doing nothing about it. Listen, you've all heard about the number of people leaving the UK, especially millionaires, and not even millionaires anymore, just everyday people are exiting the UK in massive numbers. But let me give you some stats to back it up. The UK's credit rating has gone down, which means that the government pays more interest on debt. Here's what it means for you. Higher interest rates, higher mortgages, less room for public spending.
I left London, UK and relocated to Kenya 3 years ago because I felt stuck. I felt stuck not because I lacked ability, but because the system wasn't built for me to truly thrive. No matter how hard I worked, the results didn't reflect the effort. Over time, it became clear that I had to leave. Staying in the UK would limit my growth and stop me from reaching my full potential. I know so many people in the diaspora who feel the same way I did. The UK is not always what it's made out to be. The streets are definitely not paved with gold.
I confirm, starting next month, millions of UK residents could face the terrifying reality of deportation under shocking new government laws. Even long-term residents who have lived in Britain for decades, paid taxes, raised families, and built their entire lives here, are suddenly being told they may no longer belong. The new deportation rules, pushed forward under Starmer's government, will give authorities wider powers to review immigration status.
New figures show that net migration to the UK, that's the difference between the number of people arriving than leaving the country, dropped sharply to 204,000 in the year to June. That's a significant drop from almost 650,000 in the year to June, and a drop of nearly 80% from the peak in 2023.
Breaking. A quiet but powerful shift is happening between Africa and the United Kingdom, and most people are not paying attention. African investors, once some of the most active foreign participants in the UK economy, are pulling back at a dramatic pace. Recent data points to an estimated 80% drop in new investment flows from parts of Africa into UK-based assets, businesses, and property. This is not a rumor, and it is not a short-term fluctuation. It reflects deeper changes that are now reshaping financial decisions across continents. For decades, the UK was seen by many African investors as a safe and predictable destination. London functioned as a global financial gateway. British law was trusted. The pound was considered stable. Property markets were attractive, and the UK's historical ties with many African countries made business feel familiar and accessible. Money flowed into real estate, banks, education, logistics, and retail. African capital was part of what kept several sectors active, especially in major cities. But that picture has changed. Facts on the ground now show declining deal volumes, reduced property purchases, fewer business registrations, and shrinking portfolio exposure. African investment groups are not just slowing down. Many are exiting completely or redirecting funds elsewhere. One of the biggest factors behind this shift is economic uncertainty inside the UK itself. Growth has remained weak for an extended period. Inflation has eaten into returns. Borrowing costs rose sharply, making leveraged investments far less attractive. When investors run their numbers, many no longer see the same upside they once did. Analysts warn that when returns fall while risks rise, capital almost always looks for a new home. Currency instability is another key issue. The pound has experienced repeated volatility in recent years. For foreign investors, especially those managing funds in African currencies or dollars, this creates added risk. Profits earned in pounds can quickly shrink when converted back. Hedging costs also increase. This could mean that even well-performing assets fail to deliver real gains once currency movements are taken into account. Tax and regulatory changes have also played a role. Tighter rules around property ownership, higher transaction taxes, and increased scrutiny of foreign funds have changed the investment environment. While these measures were often introduced to address domestic concerns, they have made the UK less competitive globally. African investors compare options, and when they do, the UK no longer stands out the way it once did. At the same time, Africa itself is changing. This is a critical part of the story. Several African economies are growing faster than the UK. New financial hubs are emerging. Infrastructure projects are expanding. Regional trade is increasing. Returns at home, once considered too risky or uncertain, are now improving. This could mean that African capital no longer needs to travel thousands of miles to find opportunity. There is also a psychological shift underway. Many African investors are rethinking old assumptions. The idea that wealth must be parked in Western markets to be safe is being challenged. Recent global shocks showed that no economy is immune to disruption. When banks fail, markets freeze, or policies change overnight, safety becomes relative. Analysts warn that trust, once lost, is difficult to rebuild. Political and policy unpredictability has added to these concerns. Frequent changes in economic direction, unclear long-term strategies, and ongoing debates about trade relationships have created hesitation. Investors value clarity. When future rules are hard to predict, long-term planning becomes difficult. This could mean that even investors who want to stay involved choose to wait on the sidelines instead. Education and migration-related investments have also slowed. In the past, many African families invested heavily in the UK through schools, universities, and related services. Rising costs, visa uncertainty, and tougher post-study rules have reduced the appeal. As this pipeline weakens, connected investment activity declines as well. Meanwhile, other destinations are actively competing for the same capital. Countries in the Middle East, Asia, and even within Africa are offering incentives, streamlined regulations, and clearer growth stories. Funds are being redirected into manufacturing, technology, energy, and logistics closer to home. This could mean African investors are no longer just fleeing risk but actively choosing relevance and control. The impact on the UK is subtle but serious. African investment may not always make headlines, but it has played an important supporting role in several sectors. Reduced inflows mean less liquidity, fewer developments, and weaker demand in already stressed markets. Analysts warn that when multiple foreign investor groups pull back at the same time, recovery becomes harder. For Africa, the implications are complex but potentially positive. Keeping capital within the continent can support local growth, job creation, and financial independence. However, it also places greater responsibility on local systems to deliver transparency, stability, and returns. This could mean African markets must mature faster to meet investor expectations that were once outsourced abroad. It is important to note that this shift is not driven by emotion alone. It is driven by spreadsheets, forecasts, and risk models. Investors follow incentives. When conditions change, behavior follows. The 80% drop is not a protest, it is a calculation. Some UK businesses are beginning to notice the absence. Fewer African partners are showing up at deal tables. Fewer joint ventures are being discussed. Relationships that once felt automatic now require effort. Rebuilding confidence will take time and possibly structural change. As the global economy continues to fragment and realign, these movements of capital tell a larger story. Power is no longer flowing in just one direction. Opportunity is being reassessed. Traditional financial centers are being questioned. This could mean the future of global investment will be far more distributed than in the past. The key question now is whether the UK can adapt quickly enough to remain attractive, and whether African economies can sustain the confidence of their own investors over the long term. If capital continues to choose proximity, growth, and clarity over tradition and history, what does that mean for the next decade of global finance, and where would you place your investment if you were making that decision today? As the movement of African capital away from the UK continues, a deeper pattern is starting to emerge, and it goes beyond simple numbers on a chart. The 80% drop is not only about lost money flows, it is about a loss of confidence in a system that once felt reliable. This second layer of the story explains why many African investors now believe the UK is no longer aligned with their long-term goals. One major factor is the changing cost structure of doing business in the UK. Operational expenses have climbed sharply. Energy prices, commercial rents, labor costs, and compliance expenses have all risen. Even profitable businesses are seeing margins squeezed. For foreign investors, this reduces flexibility. Analysts warn that when costs rise faster than productivity, returns become fragile, especially during global slowdowns. Real estate, once a cornerstone of African investment in the UK, illustrates this shift clearly. Property values in key cities have stagnated or declined in real terms. Higher interest rates reduced buyer demand. Rental yields have been pressured by regulations and taxes. For years, property was viewed as a stable store of value. Now, many investors see capital being locked into assets that are difficult to exit without losses. This could mean long holding periods with uncertain outcomes. Financial services tell a similar story. Banks and asset managers face tighter rules and higher capital requirements. While these measures aim to protect the system, they also reduce profitability. African investors who once used UK institutions as gateways to global markets are exploring alternatives. Financial centers in other regions are offering faster onboarding, lower fees, and clearer growth prospects. Another element driving this exodus is perception. Perception matters as much as data in investment decisions. Repeated headlines about economic strain, public service pressure, and social tension have shaped how the UK is viewed abroad. Even when individual opportunities exist, the overall narrative influences confidence. Analysts warn that once a market is seen as declining, reversing that image takes sustained success, not short-term fixes. There is also a strategic reassessment underway. African investors are no longer only seeking safe havens. They are seeking influence, partnerships, and participation in growth. Investing at home or within nearby regions offers more than financial returns. It offers control over outcomes. It offers political leverage. It offers the ability to shape industries rather than simply fund them. This could mean capital is now being used as a development tool, not just a storage mechanism. Technology has accelerated this change. Access to global markets no longer requires physical presence in London or other traditional hubs. Digital platforms, regional exchanges, and cross-border payment systems have reduced barriers. African investors can deploy funds internationally while staying based in Africa. This removes one of the UK's historical advantages. Trade realignments also play a role. As Africa strengthens regional trade agreements and builds links with Asia and the Middle East, the UK's position weakens. Investment often follows trade. When supply chains shift, so does capital. Analysts warn that losing trade relevance often leads to losing financial relevance as well. Education-linked investments, once a steady inflow, continue to decline. Rising tuition costs, housing shortages, and stricter migration rules have changed calculations for families and institutions. This affects universities, private housing, and local economies. Fewer students mean fewer associated investments. Over time, this weakens soft financial ties that once supported deeper economic relationships. For the UK, the implications extend beyond lost money. Reduced foreign participation can limit innovation, slow development projects, and shrink global networks. Diversity of capital sources matters. When one group exits, others often reassess their positions. This could mean a broader investment cooling effect if confidence is not restored. For Africa, retaining capital brings both opportunity and risk. Domestic markets must absorb larger flows responsibly. Governance, transparency, and financial infrastructure must keep pace. Analysts warn that if local systems fail to deliver, confidence could swing back outward just as quickly. The challenge is to convert this moment into sustainable growth rather than short-term redirection. There is also a geopolitical dimension. Investment choices reflect trust. As African investors step back from the UK, it signals a recalibration of relationships. Economic ties often precede political influence. Weaker financial links can lead to reduced diplomatic weight over time. This does not imply hostility, but it does imply distance. Some voices in the UK are calling this shift temporary. Others argue it is structural. The difference matters. Temporary downturns recover naturally. Structural changes require reform. Restoring competitiveness may involve revisiting tax policies, regulatory balance, and long-term economic vision. Analysts warn that delay increases the cost of adjustment. Meanwhile, African investors are watching closely. They are not closing doors permanently. Capital remains pragmatic. It goes where conditions improve, but trust, once broken, is rebuilt slowly. Consistency matters more than promises. This evolving story reflects a broader global reality. Investment power is no longer concentrated in a few historic centers. Emerging markets are becoming decision-makers, not just recipients. Africa's investors are acting with greater confidence and autonomy than ever before. As this shift continues, the real question is not simply why African investors are leaving the UK, but what this signals about the future of global finance. If traditional centers can no longer rely on history and reputation alone, and emerging regions begin to trust themselves more, how will investment maps look 10 years from now? And which economies will adapt quickly enough to remain relevant in that new landscape?